Well, good morning and welcome back to the Money Advantage podcast. I believe that we're live and we are back for an important conversation for you today about who is truly able to be successful with infinite banking. So, this question is something that Bruce and I were chatting about yesterday, and I'm just really excited to be able to talk with you about this because it's one of the insights that really separates people who are able to use infinite banking and not just have it be a strategy that seems really exciting and awesome, and they get in and then it ends up not doing for them what they were really hoping that it would accomplish, from the people who start infinite banking and use it and are very satisfied and they end up having a long track record of success. And so today we're going to really talk about what is that separation point. And Bruce, the reason that I'm excited to talk with you about this today is that I really just believe that you have some powerful insights to share why and how we can think long range, not just in the way that we normally talk about long range on the podcast with more length of years in terms of having a plan that's not just for tomorrow, but it's for generations ahead, but really thinking about what are we trying to accomplish with this tool, this strategy, this thing that sounds powerful and amazing, and it truly is, but you have to be the right person to be able to use that to your advantage. So, Bruce, I'm really excited to talk with you about this today.
Yeah, it's social media has exposed the concept of infinite banking, and then I believe that Nelson, in his book, delves into the human condition, and the human condition has many aspects that actually can thwart your understanding. It can also be detrimental to you actually carrying out the advantages of it. But the thing that I think is amazing. It's not just about infinite banking. It's about every um, aspect, especially financial in your life.
Mm-hmm.
And so then it comes down to, do you have an abundant mindset or do you have a scarcity mindset? Do you understand that money affects everything you do in your life? And some people say, well, it shouldn't affect anything you're doing. Well, we could discuss that at another podcast, whether it should or should not. But many people, it does affect everything they do in their life and amazes me. And I'm not even talking about the infinite banking concept. I'm amazed at all the people that I've sat down with. And I think it's around 6,000 appointments in my career now. How many people have no idea where their assets are, what their assets are doing for them, what their cash flow is, and what kind of financial goals they have into the future?
Mm.
And so that's another probably another podcast topic where
Sure.
where we say why does that happen, and then but the big thing is that people think infinite banking is really cool and it's going to solve all my problems, but they don't come back to what Nelson's title of his book is becoming your own banker, becoming your own banker. You must take responsibility. Now, we have to take responsibility of teaching you the concept, but then you need to take the responsibility of actually executing the concept. And we can help you along the way, but still it's becoming your own banker. Banking is a business that everybody uses almost on a daily basis. And Nelson was just saying, hey, if these banks are highly successful and if you want to control the banking function in your life, then you need to take responsibility for that. You're letting other people take responsibility for it and you're not benefiting from it. Why not take responsibility for it? To summarize the rest of our talk, I think we need to think about abundance mindset versus scarcity mindset, and then go back to the five tenets that Nelson talked about. And I think that's where we're going to go in this podcast.
Yes, I think what's really interesting is that when you think about the reason why you might be looking for infinite banking in the first place, and I think there's many reasons why people are searching out and seeking for infinite banking, whether they have just heard of this strategy, whether they're looking to, I mean, usually it has to do with building long-term wealth, having a store of capital, being in a position where you are earning interest and dividends, not just paying interest and dividends to use someone else's money. You're also having a tool that you can not only have the life insurance benefit that will pay out to your heirs, but you also have this growing cash value during the time that you have the policy, which means you have capital you can access and use. So if you come to the infinite banking concept and really you're looking for a way to preserve capital, store capital, be in a position of taking your current financial discipline and your savings habits to the next level, and you're wanting a better place to store cash, you're wanting to do more with that cash that you're storing, you're in a position to be down the track of being successful with infinite banking. I think the challenge comes in when you get into a position of saying, well, this thing seems like a magic pill. It seems like if I just put my cash in here, I'm going to instantly double everything else I'm doing. It's going to supercharge my investing life. It's going to be this accelerator, like a jetpack, this, booster to my financial life, and it's going to happen tomorrow, and I'm going to feel the effects of it tomorrow, and because of that I'm going to be in control. And when you get really short-term minded and you're looking for the things that you're normally seeing in the regular financial world, high rates of return, you're looking for um, quick quick returns, you're in a position of not being able to be successful with infinite banking. And so really, Bruce, what's interesting is that you said there's the human condition, right? And Nelson talks about that a lot. There's all of these things that limit our mindset and draw us towards scarcity all the time that we have to fight against. We have to war against them because scarcity is a way, a natural operating way, operating system that we can have in our mind from the world that we live in and that can pull us into scarcity. And we have to choose to recognize that, rise above it. And that is when we're able to have a mindset shift to be able to use infinite banking well. So
Yeah, and
go ahead, Bruce.
I just think that this episode was spurred by many meetings I've been having recently where people are jumping to conclusions from the research that they've done. And I've seen this where people say, "Oh, I want to do this because I have so much debt. It's going to get me out of debt," because a lot of people are claiming that. Okay, debt is a can be one of two things. It can be an active debt where you're actively, continue to be in debt. And if that's the case, infinite banking is not going to change that. That's a mindset that you must change first. And we tell people all the time, get out of debt first and then start infinite banking. And throughout my entire career, Rachel, of this close to 17 years now, um, only one person has ever been able to do that and come back when I told them to
That's
do that.
powerful. And I was going to ask you
Yeah.
about that. First, I was going to ask you what are the conclusions they're jumping to? So you've named the first one here. And what you're saying is if you envision infinite banking to be able to be this magic pill that's going to get you out of a negative spiral of being in a negative net worth position, being in debt, and always spending more than you make, and being in a position where you're spending on credit, you're pledging future income to pay the things that you're using and enjoying today. When you're in that position, you are not going to be able to pull up out of that gravity by infinite banking. It is not the tool to pull you up. You're saying we've sent those people to go do some work on their
Mhm.
debt. You're saying most of them don't come back. And what I'm hearing from that is that they were looking for infinite banking to be the solution, the savior to their negative financial habits. And it doesn't fix negative financial habits, right?
Correct. Correct. So um, that would be the first thing that I see a mindset that this is going to fix that. The second thing that I've been seeing lately is people doing their research and automatically hearing a talking point. So Insurance companies are no different than any other company. They have to market, just like we market using this podcast. Other people presenting the infinite banking concept also market. They tend to use little sound bites, and that's where we don't do TikTok, because TikTok is basically a short sound bite. You're trying to get people's attention. And one of the things that people use is the rich don't let their money sit. They have to get their money in motion. The rich get their money in motion. Velocity of money. Get your money working for you. And that is something that then they can try to incentivize you or motivate you to take action to get you to do this before you're even ready. And then they say you're actually thinking short term because you're going to put the money into the policy, you're going to borrow against the collateral, your cash value, and then you're going to put it in motion right away. And that goes against Nelson's first tenet of becoming your own banker, and that is think long term. And why is it important to think long term? Because that means you're establishing a habit.
Mm-hmm.
The other bad thing about doing that, which I am talking to people over and over about this, is when you get something in what you believe is a good investment right away, you oftentimes jump to conclusions on that investment and don't think it through. And thus that investment doesn't turn out to be as good as you thought it was going to be. And I'm seeing this from clients or potential clients all the time. Now they're turning to us and saying our syndications or stop their distributions. They actually have capital calls. They need more capital into the syndication, real estate syndications, by the way. These are like multifamily apartment complexes and such. And now they're in a negative cash flow situation. Mm-hmm. And they think, oh, well, then now I need to get more money out of my cash value just to help my negative cash flow. But they've already taken a lot of the cash flow out, and now they can't pay it back. Even if they were paying it back, they can't now because they stopped the distributions from the syndications.
Bruce, what I'm hearing in this
that's a short-term thinking.
What I'm hearing, we just did an episode recently called Cash is King. I think it was last week.
Mm-hmm.
And no, 2 weeks ago. And we had this whole divergence of thought where many times people think cash flow is king. And it's easy, especially in the real estate space and in the investment space, to say, get your money moving, get it in motion, get the cash flow. And yes, you want cash flow. The challenge is if you don't value having cash, holding cash, having cash available to you, you won't be in a position of being able to recognize those ideal opportunities. You're going to be jumping the gun to get into the quickest, fastest investment that's probably not necessarily the best investment. And that's what you're saying. You're saying not fully thinking things through. But I think the reason for that is it comes down to the people who are saying the rich get their money in motion. They're targeting, they're laser focusing in on the cash flow, which is absolutely necessary. But if you don't value the cash first, you'll never build up the cash to be able to invest for cash flow. And the challenge is, if you're not valuing holding cash, you're probably not going to value infinite banking for what the true benefits are either, because it's a place to store and hold cash.
Yes. And the second implication of this is if you want to get your cash, you believe you need to get your cash moving right away, then people are telling them, well, I have the solution. We're going to build really skinny base policies, very little money going into the base, a lot going into the PUAs. Thus, you'll have more cash available in day 30. And that then you can go use. Well, if you use it improperly and you don't pay it back, which is you have to overcome that human condition, which I'm telling you, is very hard for people to overcome because they don't value their own capital.
Mm-hmm.
Okay, when you borrow it from a commercial bank, and you must pay it back because it's not your capital, and you can actually get in trouble for it. You should treat your capital the same way you would have to treat somebody else's capital, but people don't do it. And I see it all the time.
We talk about the benefits of infinite banking, one of them being you're in control of the repayment terms because you don't have someone outside of you telling you that $4,782.12 is due on the 14th of each month. You don't have that. You don't have the requirement to make that payment, but we need to then lead ourselves with self-leadership to do what that outside entity was forcing on us before and have that personal accountability to be in a position to require of ourselves to make those repayments. And that's what you're saying. You're saying just because you're in control doesn't mean you should have unfettered freedom and just say, well, I'm in control of my repayment terms, therefore I'm not going to repay. That gets you into a negative position.
Yes. And then when you have and we've done other episodes on this, but I'm telling you, it's becoming very prevalent right now. People say, well, but if I only have to commit to a really small base, then I don't have to worry about the PUAs and I'm in a much better position. And I can actually borrow against the PUAs very quickly. But I found that most people don't pay it back because they're exactly what TikTok told them is they don't have to pay it back. They have to just pay the base. However, and we've been accused, when I say we, I'm talking about authorized practitioners from the Nelson Nash Institute have been accused of scaring people that their policies are going to mech if they don't pay it back. Well, they will mech if you understand this conceptually. 90% of the dividend is paid on the base part of the contract. If you
Mm-hmm.
pull that down, that means that dividend is going to be very small. That dividend cannot compound as much as if it was a bigger dividend. Now, the borrowing costs are the interest that you pay. The interest that you pay, it's going to be higher because now the volume is going to be higher because now you are starting it earlier. If you started earlier, guess what? It's going to compound going forward. As it compounds, it is then collateralized against the death benefit. In other words, the death benefit keeps going down, down, down. Then the MEC test comes in and it says you've been putting this much into the policy,
In
and
premium.
now in this form of premium, and now that you've been letting this loan compound, and the death benefit's been coming down. Oh, guess what? Now you don't have enough death benefit to support all the premium you've been putting in. So now the
Mm,
policy is going to become a MEC. And
wow. I didn't
people
realize
do,
that, Bruce. I'm glad that you
yeah.
shared that. So what I'm hearing you say is if you take max loans and you don't repay them, you can be at the risk of mecking a policy.
Oh, absolutely. Yeah, especially because in order to do those skinnier based policies, you have to put a very large, you have to put a very large term
Mm-hmm.
policy on them to get the initial death benefit up high enough. And that actually, the longer you put that term policy on there, the more expensive it is because you get closer to mortality. So what people do when they do this technique is they actually pull it down to the shortest one known, and that's 7 years.
The
Well,
shortest term
that's
policy built in.
known built in. That's 7 years to match the 7 year pay test
Mm.
of the modified endowment contract test that the Treasury Department puts on. But then it falls off after
At
that
7 years,
at 7 years, or you can keep it going, but it's going to
increase in cost, right?
sometimes increase at 10 times the cost. So $1,000 might be 10,000 that year. The next year is just going to keep increasing, so people can't afford to do it. So it falls off.
Mm-hmm.
And what makes it matters worse, even if it doesn't MEC, now it only will support the base death benefit, which is 1/10 of the original premium. Just when the policy becomes even more efficient, you're gaining more towards the cash value. Now you can't put the same amount of money in. So now you're afraid to capitalize. That's Nelson's second tenet. Don't be afraid to capitalize. Well, if you're doing a very small base, it says to me intellectually and emotionally, you're afraid I'm not going to be able to capitalize. What some
So
people
let's
might
just clarify what that
respond, well,
means. Go ahead,
yes,
Bruce.
okay, go ahead. No, I'm just going to say most people would say, well, yeah, I don't know if I can do it. Well, that's a scarcity mindset because money flows. Money's always flowing. You could always flow it to your policy.
So, Bruce, what I'm hearing you say, if I could recap that piece about the scarcity mindset, is when you have a premium going into a whole life or a properly structured whole life policy, you're in a position where you have base premium, paid up addition premium. The paid up addition is a non-required payment. You have to make the base payment. There might be a small amount of the PUA that's required, maybe $100. But usually what is happening is you're stacking this base premium that's a required payment each year or each month, depending on how your frequency is set up for paying your premiums. And then on top of that, you have this PUA that's mostly going towards cash value, and also this PUA that is not a required payment. So what you're saying, Bruce, is the person who is maximizing the PUAs and shrinking down the base, you're getting multiple challenges, but the one that you're pointing out right now is that person is saying, well, I want a narrower, smaller required payment when I get out to year 4 and 5 and 6 and 7. What if I can't pay that full premium? I want to be in a position where I have the freedom to pay less. That's what you're saying. And
Hmm.
and when they're in a position of saying, yeah, but I probably, what if things get tight? What if things get bad? What if things get, worse for me in the future and I can't make that full premium payment? I want the freedom to shrink up that payment and go down to the minimum. You're saying that's not the right starting point to think about infinite banking because that is opposite of the desire to capitalize. The desire to
It's just,
capitalize says, I want to pay as much as possible, as long as possible into this policy so I get the greatest long-term benefit. But there's a difference between the person who says, I want to pay as much as possible, as long as possible, and the person who says, I want to pay as little as possible, as short as possible. And I think that's where you get not only you get the skinny base policies where it's 10% base and 90% PUA, thinking that people there are um, just in a position where they're also not just saying, I want to have a smaller required payment with the base. They're also usually then putting those policies in like a 7 pay narrow window where they're saying, well, let's just make it so I only have to capitalize this policy for a short window rather than for long term.
mhm. Yeah, we're getting some questions here. What's very interesting is I'm not saying that people are misinterpreting Nelson's book, and Nelson does talk about paying down uh, debt, but he concentrates on what I would normally say. And by the way, this is from the Hoop Scoop, um, and I'm going to answer most of it right now. Hoop Scoop. I'm actually typing right now for you. And so what I would call normalized debt in people's minds that they pay off, like cars, your mortgage, your business credit. Yes, he may have talked about credit cards, and that actually I was getting to that when I said passive debt. I talked about active debt. Some people have passive debt. What I
Mhm.
mean by that is they've had one or two situations in their lives that have caused them to have credit card debt. And what would that situation be? Well, they had a major thing that they had not saved enough for, like a water heater going out, or a furnace going out,
Medical
or
bills.
a medical bill, something like that. So that doesn't show a habit. That doesn't show a habit that you have to overcome, like Nelson talked about, um, overcoming the human condition. Uh, and once again, I'm not saying you can't do it for debt consolidation, but I have not seen it work but one time, and it kind of makes sense unless you've gotten a really change of your habits. It's going to be very, very difficult to change that. We've got a ton of questions coming in, so Rob, you're a regular contributor. We really appreciate you listening. Rob says thinking long range applies to policy design too. It
Hmm.
absolutely does. And what's Rob, what happens here is when I start talking about this, Nelson said rates don't matter. Actually your behavior is more important. Your behavior is more important than the dividend rate or the the loan rate, but people are always asking, what's a dividend rate? What's a loan rate? And frankly, agents like ourselves, we talk about that as like it's really, really good. But the behavior is more important than those things. And what's interesting is people they actually shop illustrations all the time. Well, I got this one from this company, and look, it's better. And then I say, well, first of all, look at it. They've rated you super preferred, and we're only doing standard because a very small people get super preferred. You're actually comparing this to a design that is what is better. You're saying early cash value is better, but if you trust this illustration so much, look after 20 years, the cash value is actually less. And then those people say, yeah, but I want it now. I don't want to wait 20 years for it to be better. And then we say, well, you may not even make it 20 years with that mindset because those kind of people don't pay their loans back. And so it's very difficult for a person to look inner towards their habits and admit that they might not be performing to their best possible financial future.
Bruce, I mean,
And
that's what you said is profound right there because
yeah,
I think none of us want to admit, hey, we're probably not fully measuring up to what we could do. And yet at the same time, I think recognizing our human limitations and then putting in safeguards for that is more helpful than saying, oh yeah, yeah, of course I'm gonna be amazing in the future. And of course I don't have any financial limitations or I don't have any mindset challenges at all. I think recognizing that you do and then working to alter them is really the value, the thing that you need to go towards. If you're going to make something successful, you have to recognize the challenges of your mindset and work to up level them. And Bruce, I'm just going to add to what you said, specifically to Rob Brayton, the thinking long range applies to policy design too. So if you are thinking short term, you're going to have a smaller required payment, smaller base. You're going to have as quick of available cash value as possible because it's that quick turnover. The As soon as I make the premium payment, I'm now in a position where I have the most cash value possible. And the challenge with that short-term thinking is it doesn't allow you to have the long-term gains that you want to be able to have when you get to that point of being 20 years out or 30 or 40. Go ahead,
yeah,
Bruce.
and I was just going to say when I talk to people about this, and some people are generally not trying to manipulate the system, but they hear other people say in marketing, oh well, the reason we're doing like this is because we're giving up more of our commission so that you can actually have more cash value.
Well, it
Well, it is
sounds
true.
altruistic. It sounds
Yeah,
like,
which
oh, the
sounds like
reason
I'm the
I'm,
greatest person.
yeah.
Yeah, yeah. And although it's true, what are you giving up for that? Yes, the agent's making less money, but they are putting you at a higher degree of risk. And then you also have to say to yourself, if they're giving up more money, we have found that business owners through business consulting, their clients actually want them to do well. They want them to stay in business. They want to pay them because they're valuable. If you're saying to yourself, I'm not going to get paid very much, and that might be causing you not to be able to stay in business, or maybe you stay in business, but you don't service people as well because you don't have as much cash to hire people and service people. So the other thing that is a confusing for that, and I've heard this a couple of times within the last month, they say, well, that means that they're taking less commission from the insurance company. That's really nice of them that they're giving up their commission. They think they're taking less because they've negotiated some kind of deal with the insurance company. And I had never heard this before. Well, first of all, you can't do that. Every agent gets the same base contract. Every agent does. And for those people that say, well, you only have to do it with these companies that work out of the state of New York, they're also getting ancillary benefits that they're not talking about, like health benefits, retirement benefits, disability benefits, that the total compensation, they are actually get marketing bonus that it's not a commission, but it's going into their business like a commission would.
And so you're
So
talking about agents that might be captive agents with a certain company, and they're maybe having less paid in commission, but they're still getting paid in another fashion. Which,
correct,
I mean, if you just talk about commission, well, then you're not looking at the big picture.
correct. So, and I'm not saying that you shouldn't question everything we say too, but that is what I've been telling people is be careful who you listen to because you just might believe them. But remember, this is an actuarial product. If you change one aspect of, some other aspect's going to change in the opposite direction. If you take some of the risk of having to pay the premium out, you risk that it's going to mech. Okay, that's the bottom line. And
So you
people,
mean if you take the risk of having to pay the premium out, it's gonna mech. What do you mean by that? Let's.
well, if you take it out of the equation, if you take it out of the
Mm,
equation, so if you're
okay.
saying I want a skinny base because I'm not sure I can make the premium next year.
Yeah. Okay.
Well, first of all, you shouldn't be doing it if you're not sure you can make the premium next year. Okay,
Yes.
that means that person hasn't taken a financial picture. They haven't talked through your cash flows with you, and they haven't come to a number that they feel comfortable with that you will feel comfortable with actually saving. They're saying, let's just find a number you're comfortable with the base, and then everything else you might be able to put in will be the PUAs. That's optional. What they don't tell them, and this is another problem, is they think then the next year they're going to have cash value that's going to be proportionate to the, or I'm sorry, they don't think it's going to be proportionate to the base and PUA that they put in the first year. So now they put the base in, and the cash value only grows by a couple of $100s instead of tens of thousands of dollars. And they're like, what happened to my cash value?
Mm-hmm.
Well, that's because in the early parts, the compounding of the dividends has not happened yet, which helps keep the cash value up. The base does not produce much cash value early. The PUAs produce most of the cash value early. So if you don't put the PUAs in, you're not going to get cash value. That's a rude awakening for people early in the contract because they did not think long term. They were afraid to capitalize. We've been talking about this over and over. Nelson's next thing, don't steal the P's. People are stealing the P's all the time. Now, somebody said we've got a lot of comments. Thanks, guys, for all your comments today. Somebody said, well, should should you actually have the self-discipline is very, or it says self-discipline is very essential in order to thrive with infinite banking. And that
Mm-hmm.
means not stealing the P's. If there's two things I think you really, if you want to master this in Nelson's book, you read the grocery store example and you read equipment financing. Equipment financing is difficult to understand. Okay. If you understand
Yes.
equipment financing, you will understand the infinite banking concept. Because what grocery store says is you're stealing from your own self because you're walking out the back with the P's because you're the owner.
Which
Why
is
would you do
equivalent
that?
to taking a policy loan and not repaying it.
Correct, because you're the owner of the policy. Equipment financing shows that if you have the self discipline to capitalize for 4 years, then you borrow against the cash value to go do something useful to eliminate financing, and then you pay back above the financing level. That's paying that additional financing level is premium. So you found the premium, so you don't have to be afraid of premium in the future because things that you would normally do, excuse me, things that you would normally do in your financing life become your premium. So why are you afraid of capitalizing? You're always going to be financing things in your life.
Mm-hmm.
So if you understand equipment financing, you would not be afraid to capitalize, and you would not steal the P's because now when you put the P's back in, the next time you have financing, you're going to have the capital to do it again. And guess what? The extra that you're paying in becomes premium again. It becomes premium.
Meaning you have the ability to pay your full PUAs.
Yes. And that's the next thing that Nelson talks about. You finance everything. You either give up interest by interrupting it, by taking it out of the bank or taking it from a stock or taking it from um, somewhere that you haven't invested, or you pay interest. So you're always doing this. Capital has a cost. So now you can take that capital and pay it back and get uninterrupted compounding growth for the rest of your life if you're disciplined to do this. And the final thing, the most important thing Nelson said, when you're looking at all these human conditions, such as the arrival syndrome, use it or lose it, whenever you're trying to
Parkinson's
overcome the
law.
human Parkinson's law, that's another good one. Whenever you're trying to overcome this, you have to rethink your thinking. You have to get to a point where you're like, this part is not working for me. The pain is too difficult. I want to get out of that pain. I want to rethink my thinking and get into this more abundant mindset where I am in control.
Hmm. I think there's a couple things I want to come back to, Bruce. One, you were talking about often people don't have a really good concept of how they're going to fund a policy in the future. And the problem that happens is if somebody just says, "Oh, I think this year I can put in, I can put in 100,000 this year." And then the question next is, okay, what about next year? Are you going to be able to pay that 100,000 next year? Are you going to be able to pay that 100,000 in year three? Well, I think a lot of times people just say, "Oh, I've got a lump sum. I've saved up this cash. I've got cash sitting right here, and I want to do something with that. I want to put it to work. I want to get it in a better tool. Let me just dump in that full amount that I've saved." And so they're thinking of it as a one-time play. This one-time action that I'm going to take, and I'm going to get this cash that I've already accumulated, whether it was through a windfall, whether it was through saving through the sale of a business. Somehow you have this cash that you want to put over into a policy. The the challenge is you're saying, Bruce, if we don't do due diligence, then we're coming up with a premium amount that may or may not be realistic because we're going on feelings, or we're taking just a small piece of your financial picture and making the whole decision on how to structure a policy on that one factor rather than looking at the whole picture and determining if this is prudent to structure a policy with this much premium going in each year. And so I think what happens is that if you're just going on feelings or just one or two data points based on what you have sitting in the bank right now, you're going to be limited and you're not going to feel as confident about the amount of premium that was designed for you in this long-term payment scenario. But if you do your full due diligence, you look at your assets, where they're sitting, you look at what your cash is doing, you think about your entire financial picture, your entire cash flow, your financing, your income, your future income, your financing needs, you're looking at all of the data points to be able to come up with something that is really well thought through. And Bruce, the reason I just wanted to bring that up is that I think part of the problem that we get into with short-term thinking and scarcity is because if we rush in too quickly, thinking, "Oh, this is going to be great. It's going to solve these problems. Let's finance as much as possible in right now." And we don't do this on our team, but if another advisor says, "Oh, great, you can put in $300,000, let's go ahead and get started," and they don't really think about all of the factors, they don't consider your entire financial picture, you can come up with something that is going to feel unrealistic. And you're going to have disillusionment then about paying that long-term premium when you get to year 2 and 3 and 25 and 27, because maybe instead of being all in on something, you needed to take, what do you say, Bruce? Small steps, but quality steps.
All steps but quality steps. Um, what's it? So I would say if you understand what we're talking about, then if you're talking to somebody else and they say, how much do you want to put in your banking system? They ask no other questions like your cash flow, your assets. How much do you want to put in there? And they give you an illustration right away. Well, here's what you can do. I've had people say that they've talked to other insurance agents, and within 4 minutes, they've already had an illustration for them. That person doesn't think long term. They
Mm-hmm.
don't. I would question whether they really have your best interest in mind. Because think about this. If you went to the doctor and you said, hey, doctor, I'd really like to get healthier. And the doctor says, oh, here, just take these pills. How many do you
Or,
think you need? How many do you
yeah,
think you need to take?
yeah, yep. Or even worse, if you went to the doctor and were like, hey, doctor, I'm pretty sure that I have appendicitis. I need, this is the medication I want. Go ahead and give it to me. And they just said, oh, yeah, sure, I'll give you this medication. Well, that's clearly not what you need for appendicitis. And if they're just taking your word for it rather than doing their due diligence, that's not a wisely thought through decision.
Yeah, so this is I do believe this is becoming more and more prevalent that people have think they have found the answer better than Nelson had found the answer.
Hmm.
And if you want the answer, you just keep going back to the book. Now, there are things that have changed since Nelson wrote the book. There have been mortality changes and there have been tax changes with 7702 law that makes life insurance grow tax deferred, but you can access it tax free. That's the other thing. If they don't understand it's actually growing tax deferred, it's not growing tax free, which a lot of people say.
Hmm.
It's growing tax deferred, but you can access it tax free if you do it properly, then they don't understand how it works.
Hmm.
Okay. Because if you have to surrender the policy and you have a cost base, you go over the cost basis, you are going to have to pay taxes on money that you've already borrowed and may not even have anymore. And so that's another short-term thinking. So the final thing, Rachel, I think I just want to answer a couple of these questions because we had some really good ones.
Absolutely.
So James is cool. Well, I'm glad James is cool. I haven't seen your names before, James. Thanks for listening. He says, is paid up to 75 preferable to paid up at 100? So James, I'm gonna practice what I preach. I don't know because I don't know your situation. I would need to know more of your situation, but I'm going to talk about it conceptually though for you. Okay. So you would think what we said was, if you're thinking long range and not being afraid to capitalize, you'd want to capitalize for as long as possible, and that would be paid up to 100. But if you do that, you actually are going to change other aspects of the policy, how much the base death benefit is, how much can you put in early in the policy because you're not having as much early death benefits. So even though you can capitalize longer, you may not be able to capitalize as much. And so when Nelson wrote his book, he didn't say what the ideal, like this is the split base versus premium, a PUA, excuse me. He actually gave many, many different examples. But what you did notice is he did keep the base up because the base is the actual foundation, the hull of the boat. The PUAs is the sail. But if you have too big a sail on too small of a hull of a boat, that boat will eventually work for a little bit, but it has the potential to actually fall over because the hull of the boat's not big enough to actually hold the sail. So you have to think of that. So 75 versus 100, I would say 75 is something that Nelson found out that was a good, compromise between being able to capitalize for your entire life. And frankly, when you're 100, maybe you're not utilizing cash at that time. Where 75, you're still vibrant, so on and so forth. What
It's
we
also
what
possible,
we
Bruce, weren't the policy illustrations in the book through age 100 as well, and where they're through age 120 now or to
correct,
121?
correct. But I guess then people could say, well, could you find a company that you could fund through 121? Would be the same thing.
Hmm.
Um, so when you're looking at this, Nelson was always balancing long-term stability, not necessarily growth, but growth is a part of it, but long-term stability with the base death benefit, with the early cash that PUAs can build up, and the PUAs will eventually produce more and more dividends every year, but it won't be for a long time where they actually reach par, where the dividends from the base and the dividends from the PUAs could take up as many as 30 years to equalize. So you have to look at that balance when you're trying to do this. There's no perfect balance.
Mm-hmm.
I was so happy. I was talking to a client the other night, and I didn't think they were getting this, and they finally said, "Oh, so I understand now. If I do one thing with the PUAs, it's going to affect my base, and if I do something with the base, it's going to affect my PUAs, and if I do something with the base, it's going to affect my term, and if I do something with the PUAs, it's going to affect my term." And I'm like, yes, they all are in concert.
Mm-hmm.
And so you can't just say there's one particular. And then I said, because he said, like, he kept saying, I want to see the numbers. And I said, well, I can project up to your age 121. You're 43. Do you know in 10 years how much you're going to utilize this? Are you going to pay all your PUAs? Are you going to take a loan? Are you going to pay the loan back? Do you know what you're going to do from now until age 121? Do you know what the dividends are going to be? Sometimes they're going to be higher, sometimes they're going to be lower. So we cannot, nobody can do this. Nobody can show you that because it's unknown into the future. But if you understand the concept, you can take advantage of the concept that you're becoming your own banker. Your behavior will determine how well this system works for you.
Bruce, I want to point out that it's important to recognize what we're not saying is you should have 100% base and zero PUAs. That was not the ideal design either, because Nelson did want to have that early cash value. He wanted to maximize what you can do with the policy now and in the future. And that's why we're talking about this balance with that long-term stability and having that cash value that's growing. I mean, certainly don't hear what we're not saying. Don't hear you should have an all base policy in every situation, because, I mean, there are times for that, right? But we're not advocating that everyone's policy should be all base and have zero cash value buildup until really far out in the future. But there could be a reason. I know people who have designed policies that way who are within our industry, and the reason they did that is so that they could have the most long-term growth.
Yeah, it's interesting. Those people get demonized. It's like Nelson had many all base policies when he was young because that some of the companies didn't even have PUAs, and PUAs didn't really even come into vogue until the 80s. And so a lot of ordinary life policies were all base. And matter of fact, 4 years ago, in this coming December in 2024, I will have funded my fourth premium with my wife's policy that is all base, her second policy, which is all base. And I did that because I was looking at a low interest rate environment, and I knew dividends from my experience, my career, dividends are interest rate sensitive, and interests are going to normalize, and they did. They actually went up and normalized. And so we are going to have the headwind of having the entire base dividend be as big as possible. And so we will capture any of that growth. And I tell people all the time, just think about this. If the 10-year treasury just 3 years ago was sitting at 0.75, 0.75%, and now it's 4% as we're talking here in 2024. Well, some people think that's a 3.25% increase,
It's
but
like
it's no,
300
it's a
sometimes.
325% increase. Can you imagine what that's going to do to future dividends? Now, people that say it's not a good rate of return, they're actually going to be amazed how good a rate of the return is. So now, although we're not building it for the rate of return, you're going to be able to have your cake and eat it too.
And
So
what you're saying, Bruce, is you put in a policy in a time, you put it in force during a time in which the illustrated dividend into the future was low. And
yes,
as the treasury rates go up and as the dividends go up inside the policy, it's going to be better than that particular illustration showed before you started the policy, which that
exactly.
is profound. You're not just saying for any new policies you put in place, you're talking about it showed on the illustration when I got into the policy this low dividend amount, low dividend projections. But now, because it's all base and because dividends are primarily paid on the base premium, you're going to have this much higher dividend rate than that illustration projected, and it's going to apply near 100% because the 100% base. So, I mean, just
Right.
a wise way of looking at the future. And I hope that if you're listening, you can hear that our heart in this is not to tell you it needs to be a particular way, but really that our desire is to bring you caution and also just wisdom in making these decisions, because it's not just about having one policy. It is about designing a system of infinite banking policies. And often that takes years and time to put these in place, whether you're insuring multiple policies on yourself, on your spouse, on your children, on your parents. You have a lot of capability in what you're looking to do within infinite banking. And because it's not just a one-time transaction, it's not one time and it's not one policy. So you don't have to put everything possible into first year premium payments and then wonder about second year, third year, fourth year premium payments on the basis of just that one policy. You have the ability to design multiple policies around these ideas and take advantage of long-term growth.
The last thing I'd like to say today is I just want people to have the understanding that there's not the perfect design, but there are consequences to every design. And I've heard people say, well, yeah, they told me it was going to be a mech in year 15, but don't worry about it because you just won't put that much in there anymore. You won't put as much premium in that year. It can't accept that premium. And I'm like, year 15, it becomes really, really efficient. So when you put $10,000 into a policy, the cash increase at the end of that anniversary year might go up $15,000. You have a money making machine. So why would you design a policy to actually thwart how much premium you can put that year, or it'll mech? I mean, it really doesn't
Wow.
make any sense to me. But
So
people are
that,
designing policies all the time like that. They're saying, well, yeah, but you're going to get your money in motion. And year 15, it shows it's going to mech, but we just won't put as much premium in as we're showing right now. And then it won't mech. Well, yeah, but then you're also not going to get the return.
mm, I think that is just a powerful way of looking at the idea of desiring to capitalize long term and being able to think long range. If you understand how the policy works and you understand that the maximum efficiency and the maximum stability is going to come from base premium, and you're in a position where you're not just looking for the first year and the second year and the third year, you're in a position where you will want to continue paying premium as long as possible into that policy. And because of that, it's even more important to design it properly upfront. Bruce, I think this has been a really helpful conversation, and thank you all for the comments. Thank you for the questions. If this has been helpful to you, you can share this episode with your friends, with anyone who you think is looking for this information so that they can make good decisions about their financial life, about getting started with infinite banking. So please go ahead and share it, like, comment, and I would encourage you as well to, if you're ready to start making some decisions about infinite banking, whether you already have some policies under your belt or whether you're getting started for the first time, we'd love to hear from you. And you can book a call with our advisor team at themoneyadvantage.com and go down to our calendar. It's right on the front page, and you can talk with our team about what would be the right design for you so that you can maximize your advantages and benefits and really build something that you're going to be not only proud of, but that's going to perform powerfully for you for generations to come. So we invite you to do that. Thank you so much for joining me on this important conversation, Bruce, and just for sharing your wisdom that has been built from just the volume of experience that you've had in this industry. In
Yeah, and
closing, go ahead.
I would just like to say that our advisor team has been trained by me for at least a year before they are actually seeing any people that are inquiring towards the money advantage. So each one of our teams actually have the same philosophy, which is the Nelson Nash philosophy. And if you think infinite banking is great, then you ought to go to the Bible, becoming your own banker.
Absolutely. Well, in closing, please remember success leaves clues. So model the successful few, not the crowd, and build a life and business you love. We'll see you next time.